All right, hi everybody. Welcome to Nonprofit Accounting for PPP Loans. My name is Kyle Robbins. I am a Senior Audit Manager for Larson and Company. We are a large local regional firm. We specialize in nonprofit accounting. We have several nonprofit clients throughout the state of Utah. We have over 80 nonprofits that we work with at any given time. So we are specialists in the nonprofit area, and we are providing you with this training to help you get a good understanding of how you should be accounting for your PPP loans. This training should be fairly short, should be within, under 15 minutes or so. So hopefully it provides you with a good brief explanation, but a good solid understanding of how you should be accounting for PPP loans. So let's go ahead and get started on this. So I'm going to go through 4 different things. There's a technical practice aid that has come out specifically for nonprofits that kind of explains how nonprofits can be accounting for their PPP loans. We're going to go through the different models that technical practice aid provides. So first is the debt model, and then there's the grant model. And then finally, we'll talk about some of the disclosure requirements that will be applicable depending on which model you follow. So we'll get into that as well. So first of all, the technical practice aid that has come out. So in the Q&A section 3200, it covers this. And the question is, for nonprofits, it's, this is the legal form of a PPP loan is debt. It's a debt agreement, note payable. So the question is, should the PPP loan be accounted for as debt? And then there's also the question of, okay, well, if it's forgiven, is it a government contribution? Should it be counted for as a grant? So in this guidance that came out, it essentially said, hey, nonprofits have the option to follow either of these options. So there's the ASC 470, which is the debt model, or they can follow ASC 958-605, which is the grant model. So we're going to get into those 2 different models. So first of all, we will talk about the debt model. So a nonprofit may elect to account for its PPP loan as debt in accordance with FASB ASC 470. So how would you go about doing that? First of all, when you receive your cash, you record that cash received as a note payable. And then you would essentially account for it just as you would your typical debt. As you accrue your interest, you would need to account for that. You need to accrue interest expense and then your accrued interest expense. So one thing to point out though as well is the nonprofit does not need to impute interest. So the PPP loan interest rates are low rates, which could be considered lower than the market rate. However, because the rates are prescribed by a government agency, you're excluded from the guidance on imputing interest. So you do not need to worry about calculating an imputed interest rate and worrying about that. So, but you do need to accrue the interest based off of the rate that you are receiving in the note agreement. So assuming all or some of the loan is forgiven, income would be recognized when the nonprofit is legally released or the debt is officially forgiven. So that's when you've applied for forgiveness, you actually get the notification back from the SBA or from whatever other entity you may have gotten it from. If you get it forgiven, once you are officially forgiven and receive that notification, that is when you would recognize that as revenue on your income statement or statement of activities in the nonprofit case. All right, so that's the debt model. Some positives, negatives of the debt model. One positive is it's similar to how for-profit entities are accounting for these loans. So you'd be accounting for it similar to a for-profit entity. A negative is following the debt model, you would need to account for accrued interest. You would want to accrue your interest, and then as it's forgiven, you would recognize that as revenue as well, because the interest is going to be forgiven with the PPP loan. And a negative is that it does have a later income recognition date than the grant model. And we'll kind of get into that as we talk about the grant model. So those are just a couple of positive and negatives we thought of. There could be other positives and negatives out there depending on your organization and your specific agreement you have. So that covers the debt model. So let's get into the grant model. So the other option you have to follow. So if the nonprofit elects not to follow the debt model, but you do expect to meet your forgiveness criteria, you should account for it as a conditional contribution. And this is in accordance with ASC 958-605. So that's the conditional contribution guidance. And essentially you recognize the cash received as a refundable advance. So you debit your cash and you would credit this refundable advance, which is a short-term liability. So the full amount would be a short-term liability under the debt model that we talked about. If you are using the debt model, you would technically want to break it out between short-term and long-term, depending on the terms of the loan itself. In this case, you would just, in the grant model, you would just need to recognize that as a short-term liability. And then the contribution revenue would not be recognized until the conditions are substantially met or explicitly waived. So this brings on another question of, okay, well, when are the conditions met? And so there's some additional guidance that has come out through the AICPA for that. So let's talk a little bit about that. So there are three different approaches you can take, and it's important to make sure you kind of select which approach you're going to take and have a good rationale and good reason as to why you're following that approach, just to support your decision in which approach you're following. So the first approach is you can recognize contribution income as you incur the qualifying expenses. However, you would want to reduce that contribution income based off of your estimated reductions for headcount and pay reductions. So, you know, if you're not expecting to get full forgiveness, if there's like 5% of your loan that probably won't be forgiven, then you would want to reduce those expenses by 5% and recognize that amount as contribution income and reduce your PPP loan liability, or your refundable advance in this case, by that same amount. So this is an acceptable approach. It is the least conservative approach. It's more aggressive. And in my opinion, if you do follow this approach, you will want to make sure when you're booking the revenue that you do have good support behind the amounts that you're recognizing, that you're tracking those expenses and kind of have that support to back the entries you're making to your contribution revenue. So the second approach is a little less aggressive, a little bit more conservative. And that would be you could recognize your contribution once the final forgiveness amount is calculated. So that could be at the time of when you calculate your forgiveness amount, you fill out your application, and you submit that application to the SBA or whichever entity you submit that application to. And the rationale behind that is once you have that calculation amount, you're fairly certain that that's the amount you're going to be able to recognize. And you, at that point, you have those expenses. You've incurred those expenses, you know the total expenses you've incurred. And so you just have a good estimate as far as the amount that's going to be forgiven. And the likelihood is fairly high at that point. That's the amount that's going to be forgiven. So that is the second approach you can follow. The third approach is more in line with the debt model in that you would recognize the contribution revenue once you actually receive forgiveness from the SBA. So once you get the notification back, hey, this is your loan has been forgiven. This is the amount that's forgiven. At that point, you would recognize that amount as contribution revenue and you would reduce your PPP loan or refundable advance by the amount that was actually forgiven. So those are the three approaches within the grant model that you can elect to follow. Some positives and negatives here. So I think a positive is that you don't have to accrue interest for your loan. It's a refundable advance. You just leave that amount as it is. Once you have been forgiven and you do have part of the loan that you do need to pay off, at that point, you'd want to start accruing your interest for that. However, you don't need to worry about it until the forgiven point. If you do follow the first approach, I think it does add some additional work as far as tracking your expenses and making sure those line up with the contribution revenue you are recognizing. So that first approach is when you're recognizing it as the expenses are incurred, you would want to make sure you're tracking those appropriately and maintaining the support behind the contribution you're recognizing. The third thing is you do have more control over timing of recognition, but you've got to be careful with that. You don't want to pick an approach to kind of manage your earnings. You want to have good, solid explanations and purpose behind which approach you take, not just, hey, next year we're probably not going to have as much contributions, so we're going to take approach 3. Like that's not a good reason behind it, because that's kind of managing your earnings. So while you do have more control over it, you do want to still make sure that you have good explanation and good rationale as to why you are following that approach. And then there could be other stuff too, but those are just some things that we came up with as positives and negatives. So now that you've accounted for it, let's talk a little bit about some of the disclosure requirements that will be in your financial statements for the accounting for PPP. So nonprofits with material PPP loans, they do need to adequately disclose their accounting policy for these loans and the impact that it has on the financial statements. So here's an example disclosure that you could use. This disclosure I would put in just your summary of significant accounting policies. So in this case, it explains that the nonprofit received a PPP loan, it gives the amount of the loan, and then it goes in and explains how you are accounting for that loan. So which approach you've elected to follow, whether it's the debt model versus the grant model. So in this case, this example is the grant model. You're treating it as a conditional contribution. And then you do want to disclose kind of the expected timing. So like the blue part here, you'd want to disclose which approach you're taking. So if you're taking the most conservative approach of you'll recognize it as revenue when you receive actual forgiveness, then you'd put that in there. And then that last sentence kind of explains when that is expected to happen, or the latest time of when it's expected to happen. So your application for forgiveness is due on a certain date. So that's kind of a quick disclosure requirement explanation. I have a couple of more examples on this next page. So this is a debt model example, and this kind of shows where it would be recorded on the balance sheet or statement of financial position. So in this case, under the debt model, you're accounting for it as debt and as a loan. This example this is not a classified balance sheet, so it doesn't have it broken out between short-term and long-term. If you do have a classified balance sheet, you would want to have that broken out according to the loan agreement. And then if you are using the debt model, I think my personal opinion is that it'd be a good idea to have its own note, not just have it in the summary of significant accounting policies, but you'd want its own note to kind of explain it. So this is an example of a note you could have, and it's pretty similar to what a standard note would be for a note payable, but then throwing in just some of the PPP specific things. So you disclose when you got the note, the amount of the note, the interest rate on the note, and then just some other terms related to the note. And you can read through this example, and it gives all that necessary information. Okay, and then the grant model. So under the grant model, as we mentioned, you'd want to include it as a current liability. You'd just call it a refundable advance, which in this case, that's what it's called. And then in the summary of significant accounting policies, you would have a section for your refundable advance that just kind of explains what that is and how you're accounting for it. So in this case, similar to the debt model, you are disclosing that you got a PPP loan, what the amount is, and then just the method you're following. So in this case, you're following FASB ASC 958. You're treating it as a conditional contribution. And then you do want to disclose kind of your expectation for when those conditions are going to be met, which we covered in a couple slides ago. So these are two examples of how you would want to have the PPP loan disclosed in your financial statements, depending on the model you're following. This grant model example does have a classified balance sheet, so it does show the refundable advance 100% as a current liability. Okay. If you have any questions on how to account for your PPP loan, feel free to reach out. If there's anything that wasn't super clear in this training, you can send me an email, give me a phone call, and I can help answer any of those questions you have. You can reach out to anybody else here at Larson & Company that you work with specifically. And they've been through this training, and they also know how these things should be accounted for. So we've got you covered here. So yes, feel free to reach out. Here's my last slide, just giving you some more specific information on how to contact me or how to get more information on Larson & Company, specifically our nonprofit practice. So thank you for joining us. Hopefully you've learned some important things on how to account for your PPP loan. Thank you.